And thank you for joining me here. I'm Don Ma. U.S. stocks ended lower on Wednesday. The markets today just kind of waffling around. And the reason for that is tomorrow is going to be the CPI report for July being released. S&P 500 lost 31 points or 0.7%. NASDAQ lost 162 points or 1.1%. The Dow fell 186 points or 0.5%. Casino owner Penn Entertainment's shares rose on a $2 billion deal with Walt Disney's ESPN, and it was to launch a sports betting business. Walt Disney's shares fell, erasing early gains ahead of its quarterly results due after the bell. And Americans' credit card debt has hit a record high. According to data from the Federal Reserve Bank of New York, Americans' credit card debt surpassed $1 trillion in the second quarter for the first time ever. The New York Federal Reserve data shows credit card balances have risen for 5 consecutive quarters and increased by some of the steepest rates in 2 decades. The chief credit analyst at LendingTree says what's driving credit card debt is inflation, as well as higher interest rates and the overall cost of living. Earlier Tuesday, Bank of America reported that more people were tapping their 401k accounts due to financial distress. The number of people who made a hardship withdrawal during the second quarter surged more than 35% from the first 3 months of the year to the second quarter. And Penn Entertainment reported a better-than-expected quarterly profit on Wednesday. The company late on Tuesday announced a $2 billion deal under which it would rebrand its sports betting business. Here's more.
Shares of Penn Entertainment soared 15% on Wednesday after the company announced a $2 billion online sports betting venture with ESPN called ESPN Bet. The move launches ESPN, which is owned by the Walt Disney Company, into the expanding and lucrative world of online betting. Under the terms of the deal, Penn will pay ESPN $1.5 billion and give the sports network options to buy $500 million in Penn stock. Penn's sportsbook service will be rebranded and relaunched as ESPN Bet this fall across the 16 legalized betting states where it has licenses. In its earnings report Wednesday morning, Penn said revenue from its interactive segment, which includes online sports betting, increased more than 66% in the second quarter. Sports betting is live in 34 states and Washington, D.C., and is legal but not yet operational in another 4, according to the American Gaming Association. Shares of Penn rival DraftKings were down 9% in Wednesday morning trading. Disney shares were slightly lower. ESPN's parent company reports quarterly earnings after Wednesday's closing bell.
And expect to hear from Google if you have an account but haven't used it in a while. The company is starting the process of deleting accounts that have been inactive for at least 2 years. The accounts will go away in December. The company says it will send out multiple warnings to people before the accounts are deleted. Google announced the new policy back in May. It says deleting older accounts is a security issue. The company says these accounts likely rely on recycled passwords and are less likely to have security features like two-step verification. That makes the accounts vulnerable to phishing, hacks, and spam. And Sony's logged a hefty drop in first quarter profit, and it's going to be hurt in part by a weaker performance from its movie division. But the entertainment giant remained hopeful about prospects for a record year for its PlayStation 5 console. Here are the details.
Sony is banking on a historic epic to be its next big box office hit. Ridley Scott's Napoleon is among its upcoming releases. But this has not been a vintage year for movies from the Japanese giant, and that's showing up on the bottom line. Sony said Wednesday that first quarter profits had tumbled, partly due to a weak showing by films. Operating profits slid by almost a third to $1.8 billion. Profit at the movies division was down by 2/3, hit by higher marketing costs as it released more films in theatres. Once a consumer electronics giant, Sony has reinvented itself to focus more on making movies, games and other content. It may now spin off its financial arm to raise funds for investment in entertainment. But hardware hasn't totally gone away. The firm says it expects to sell 25 million PlayStation 5 consoles this financial year. That would be a record for any generation of the device, for which cumulative sales already top 40 million. Production of the latest model had been hampered by chip shortages and other logistics snarl-ups, but those problems are now easing.
Meanwhile, China's consumer sector fell into deflation and factory gate prices extended declines in July. This is as the world's second largest economy struggled to revive demand and pressure mounted on Beijing to release more direct policy stimulus. Take a look.
While the rest of the world grapples with inflation, China appears to be sliding into deflation. Consumer prices fell in July. Factory gate prices also extended declines last month as the world's second largest economy struggled to revive demand. The National Bureau of Statistics said Wednesday that the Consumer Price Index dropped 0.3% year-on-year in July. It was the first decline since February 2 years ago. The Producer Price Index also fell for a 10th consecutive month, down 4.4% and faster than forecast. Markets are worried China has entered an era of much slower economic growth similar to Japan's lost decades. That saw consumer prices and wages stagnate for a generation. China's post-health crisis recovery has slowed after a quick start in the first quarter. Demand at home and abroad weakened and policies to support the economy failed to shore up activity. The data comes a day after the trade figures showed exports and imports both slumped in July. For now, authorities are downplaying concerns about deflation. Last month, the central bank said there would be no deflationary risks in China in the second half of the year, though it did say the economy needs time to return to normal after the health crisis. Now there is pressure on Beijing to release more direct policy stimulus, as the stock market is mostly underwhelmed by the lack of firm action. Policymakers have recently announced measures to boost sales of cars and appliances, but some market participants say stronger stimulus is needed. Investors have waited for policymakers to inject stimulus after last month's Politburo meeting.
And changes are coming for iPhone users, and it might take your thumb a while to adjust. Apple says its new updates include the moving of the end call button to the bottom right of the screen. It's currently at the bottom middle of the phone. And another new feature that is coming is the live voicemail feature that can transcribe a message from a caller in real time, which will make it easier for users if they want to ignore the incoming call. There's also a tool called Name Drop where users can share contact info by placing two iPhones near each other. The latest operating system is expected to debut next month. Meanwhile, tornadoes, floods, and blizzards, just some of the weather disasters the U.S. has experienced through the first 7 months of this year, and they've been costly. A new government report says it tracked 15 weather events where the costs and damages exceeded $1 billion, and that's a record. The National Centers for Environmental Information keeps track of this information and says the number of billion-dollar storms is the highest since 1980. Overall, the weather disasters have cost nearly $40 billion and are to blame for more than 110 deaths so far this year. And S&P Global has dropped its ESG rating system it launched in 2021. The system was to score publicly rated companies on environmental, social, and governance factors when assessing their credit quality. S&P Global, which is one of the world's largest raters of corporate debt, said the decision will take effect immediately. And now I'm happy to bring in Will Hill, the Executive Director at Consumers Research. So Will, S&P Global will no longer publish ESG scores along with its credit ratings. Can we come to the conclusion that the ESG scoring system has not worked in the past couple of years, and that's why S&P is dropping it?
That's a great question. Basically, that's what S&P admitted to, is that the scores themselves really weren't that useful for anyone who's tried to use them. And we're really seeing a retreat across the entire ESG industrial complex as it becomes more and more clear that these scoring systems don't really work as advertised.
And I want to point out some of its flaws, and maybe you can help me with that. But I think one of them is that the ESG rating is very vague. It's applying unmeasurable factors on companies. For example, like if you get a 1 out of 5 score, I mean, what does that even mean?
Right, exactly. And there really is no clear way to determine these ESG scores. Everyone that does them slightly differently, and it really comes down to extremely subjective measures. It comes down to the opinion of the personnel that happen to work at these companies. When you look at things like the S, for example, it's supposedly about the company's stands on social issues. That's an eye of the beholder. Somebody who's far left will see things one way. Someone who's maybe more in the middle will see them another. And it really comes down to making basically values-based judgments about the politics of certain companies, which not only does that push those companies in political directions because they feel like they need to curry favor with these graders, but it has nothing to do with the underlying performance of these companies, which is what S&P is supposed to be in the business of judging, not these subjective value-based measures.
Right. And one of the indicators in ESG is human rights. I mean, how do you put a score? How do you measure that?
Well, to tell you the truth, they don't, because one man's human rights in one country is looks horrible in another. And what I mean by that is the S is not graded across all countries equally. So when you look at an S score in a company that's got most of its operations in America, the companies that score the ESGs often treat American companies on a very different playing field than companies that operate in the third world or operate in China or Russia, for example. And so when you're looking at an ESG score, it's not even clear, regardless of the subjectivity of the human rights measurements being made by the personnel that's doing it, it's not even clear that those standards are being applied evenly across companies across the world, or even their operations in different countries. For example, a lot of electronic vehicle companies have very, very high E and S scores. Yet the cobalt that's necessary to build the batteries for these cars, often almost all of it is mined in open pit mines, staffed by child slave laborers in the Congo. And then it's moved to China, where most of it is processed. About 90% of the cobalt in the world is processed in China, with almost no environmental controls and a ton of emissions into the air. And yet these EV companies have very high ESG scores because what happens in the Congo and what happens in China are treated very differently than what happens here in the United States. So these scores are nefarious, but they also just don't make a lot of sense. And it's not surprising that they haven't been useful for investors.
And that's another criticism of ESG, that the E part, for example, has not helped the environment.
Not at all. And in fact, there's more and more studies showing that not only does it not help, often companies run to the E score when they're actually hiding things that have gone on in their company's operations. What I mean by that is the E is really, this environmental score in ESG is almost exclusively focused on what they call net zero targets, meaning net zero carbon emissions by 2050. And by focusing on that, by almost fetishizing that, it helps actually distract from real issues like the ones I mentioned in the Congo, with environmental problems that some of these companies have had. So the EO is almost there to distract from environmental issues, not to actually make the companies focus on them and clean them up.
Yeah, and that's a very good point. Also, would you also explain why a focus on ESG may actually not lead a company to making profit?
Well, you almost said it in the question. It gives the company something that they can focus on talking about to their investors and to the credit rating agencies like S&P that has nothing to do with their ability to provide a high quality product at a reasonable price and make a profit on it. It's not has anything to do with their bottom line. And again, there's been studies that have shown that in bad quarters, the CEO or whoever gets on the investor call, the mention of ESG tends to go up for companies that are having bad fiscal return. So it is the refuge of charlatans. It is for people who cannot perform, or their companies have not been performing, and so they run to the ESG metrics to say, hey, we may be losing money or not making as much as we should, but don't worry about it. We're really crushing it with these ESG scores.
And correct me if I'm wrong, but it's a fact that more often than not, that ESG, environmental, social, and governance risk, is not on a company's balance sheet or earnings statements.
Not at all. There is a move at the SEC to start requiring climate disclosures. We expect the rule will be published probably before the end of the year that requires them. requires that. But again, those don't have anything to do with the underlying returns to shareholders. This is, in my opinion, a completely illegitimate requirement that the SEC is putting on because of their far left agenda and caving to far left environmental pressure groups that are obsessed with so-called net zero targets. But in terms of actual returns for investors, there isn't a single portion of ESG that really pertains to that at all.
So with S&P Global dropping this ESG rating system, is it done? Is ESG over?
Well, I think we're still in the early innings of this fight for a couple of reasons. The term ESG is increasingly viewed negatively by investors. It's become clear that all the promises of higher returns that ESG originally made have yet to be fulfilled. And in fact, it tends to hurt returns because you're focusing on something else. That said, a ton of power has been aggregated in these large asset managers and companies like S&P, because imagine getting to go into corporate boards and micromanage the way they run their company, getting into the details of not just their environmental issues, but their social positions, their political positions. It's going to be a while before Wall Street wants to give that up entirely, but this is absolutely a promising development in the fight against ESG and unwinding this scam. The fact that they are increasingly moving back from ESG in the term really shows that the pressure that has been applied and the attention that's been shown explaining the scam is working. And so consumers should feel empowered by this newest development. Even if it isn't the end of the war, we're going to have to keep pushing.
So are we going to see less mention of the word ESG and perhaps almost the same in terms of actions and narratives?
Yeah, I think there's no doubt. You had CEO of BlackRock, Larry Fink, the largest asset manager in the country, and one of the biggest pushers of ESG, recently, a couple months ago, said in an interview that he was embarrassed, ashamed that him and BlackRock had been pulled into the conversation via ESG, and ashamed of the attention that company has been getting, and that he was going to stop using the term. Now, he assured everyone in the interview that he was still a quote-unquote conscientious capitalist. So basically what he's trying to do is rebrand many of the actions that he does in using other people's money to push a far-left progressive agenda. But just the fact that he's had to admit that ESG has led to shame for the company, that he's embarrassed of that, is a very promising development. And our organization, Consumers Research, is going to keep shining a light on his activities. We think destroying the ESG term is a promising development. We have to make sure that we follow through and make sure that these companies change their behaviors as well, not just their branding.
And on the point that you're from Consumer Research, how does this impact the consumer then?
That's a great question. So all the things that ESG pushes take the eye of the corporation and the companies that serve consumers off the ball of what their main mission is, which is to make sure that they can provide high quality goods at reasonable prices to you. And much of this stuff actually costs the company more money, especially as they push these troublesome net zero targets. Those costs have to be passed along to the consumer because they're industry wide. And so eventually everything from gas companies to public utilities to agricultural companies, from the grocery store to the gas pump, prices have to go up because they have to pay for these strenuous ESG requirements and these micromanaging that Wall Street wants to do in corporate America. And
I wonder if, perhaps this ESG thing is forced onto some companies. I wonder if, a majority of companies, do they care about ESG? I mean, are their primary goal to make money or to satisfy this ESG standard?
Yeah, that is a great question, and it's a mix, and it really depends on whether the company is doing very well or not. If you've got a company that's performing well, that's making money for its investors, ESG is just a distraction that they have to deal with because Larry Fink happens to control a large number of their shares of stock. If you've got a company that's failing and not doing very well and management is worried about getting replaced, all of a sudden you hear a lot of talk about ESG and hitting ESG metrics from that management team because they're trying to signal to Wall Street, please don't fire us, please don't punish us for our poor performance. Focus on the fact that we've caved to your political demands. Now, consumers are hurt by that as well because, again, if it's a company that whose management team is not doing a good job of serving the market, of serving consumers, they need to be replaced. They need to be punished. They don't need to have their pay packages approved at high levels, right? A change needs to be made. But ESG allows them a refuge, an escape to focus on these non-pecuniary, these non-monetary issues that don't reward shareholders and don't serve consumers. And so absolutely, it's sort of a mix. And companies that are doing very well with good management teams, they don't care about ESG. Companies with bad management teams, ESG is their biggest friend.
All right, so I want to wrap up soon, but I wonder something about the oil sector. Are they moving away from ESG? Because I've been seeing headlines where they're increasing oil production.
Yeah, yes and no. So they still, unfortunately, because Larry Fink and BlackRock and some of the other large asset managers like Vanguard and State Street control so much of the shares outstanding of those companies, they still have to play along with a lot of the tune that Larry Fink and BlackRock are playing for them, focusing on net zero targets that don't help consumers, don't help find a cheap, affordable gas for consumers. That said, because we've had an energy crisis here in the last few years due to COVID and war in Ukraine, you're starting to see a higher amount of capital expenditures looking for new oil and gas projects. So we're kind of coming out of, I think, the peak of the ESG underinvestment in new oil and gas projects. And part of that is actually led by the asset managers, because as we've shined a light on their ESG scam, they've gotten embarrassed and they realize they're getting called out for the energy inflation that they've helped cause. And so they're trying to kind of back up a little bit too in terms of the pressure they're putting on these companies. That said, we're still seeing companies make investments that are not particularly profitable. Exxon just spent billions of dollars buying a carbon pipeline. This isn't a pipeline that pumps gas. This is a pipeline that would allow them to help sequester carbon from the atmosphere into the ground. That does nothing to help consumers. All that does is add to the cost of Exxon that they have to pass on to the consumer in terms of higher gasoline prices.
All right, just one final question. If the term ESG in the future is gone, how do you fight back against something that you can't see, or something that's intangible?
Well, I would caution people. ESG may stop being used by Wall Street, but the phenomenon is not going to go away. ESG, the phenomenon, is anytime the financial services industry, whether that's the big banks, big asset managers like BlackRock, or the big insurers, try to use their market power to dictate the way this country runs and the way consumers live their lives. And that phenomenon is probably not going to go away anytime soon. We're going to be fighting that, I think, at least for the next 3 to 5 years. But we're going to be out there calling that out no matter what the other side is calling it. And if they rebrand as stakeholder capitalism or conscientious capitalism or whatever new term they come out with, sustainability, we are going to be out there calling that out, because we care about their actions and the effects it has on their consumers, not on whatever their new branding vehicle is.
Right. I guess we just have to watch out for the actions themselves. But thank you so much today.
Watch out for the shell game. It's coming.
All right. Thank you so much today, Will.
Thanks so much for having me.
And just a quick recap of markets from yesterday, because I was away. All three major Wall Street benchmarks finished lower on Tuesday, in a broad sell-off after the downgrading of several lenders by credit rating agency Moody's. It reignited fears about the health of U.S. banks and the economy. Here's more.
U.S. stocks closed lower on Tuesday after credit rating agency Moody's downgraded several lenders, raising fears about the health of U.S. banks and the economy. The Dow dropped nearly 0.5%. The S&P 500 fell slightly less than that, while the Nasdaq dipped about 0.8%. The indexes have fallen 5 out of the 6 sessions so far this month. Pence Capital Management Chief Investment Officer Dryden Pence says he thinks this is a sign that the huge technology stocks that have led the market this year are slipping and giving way to other unloved sectors.
I think what we're beginning to see is this shift occurring. We've had such a strong rally with 7 to 10 stocks so far in the year. We're beginning to see a shift out of some of those ones that have really led and transforming into what we believe is a broader market rally, kind of the leadership by the laggards, if you will, based on the fact that we see very low likelihood of recession this year. So I think this is the beginning of a little bleed from the high flyers, and then we'll see this spread out a bit into the rest of the market.
Pence said the shift he spoke of could benefit energy and healthcare shares. 2 healthcare stocks had strong showings Tuesday, including Eli Lilly, which surged 15% after the pharmaceutical firm posted upbeat quarterly profits, and Denmark-based Novo Nordisk, which jumped 17% after saying its obesity drug Wegovy reduced the risk of heart disease.
And the Energy Information Agency, part of the U.S. Energy Department, has forecast the Brent crude oil price to increase for the rest of 2023 and to approach $90 per barrel later this year. And now with me to talk about oil prices is energy expert Tom McNulty, president of TJ McNulty and Company. So I wanted to ask you, the Energy Department is forecasting oil prices to approach $90 a barrel, around 86-ish later this year. So I understand you have a lot of experience in the energy sectors. So what do you think, Tom?
Yeah, that's the EIA, right, from the DOE, the alphabet soup. I think it's a little bullish. I mean, keep in mind, when prices are high, companies and countries that make oil barrels try to make more. I mean, it was just late last night, I think, that Iran has announced they're going to increase production. They're going to try to get to 2.5 million barrels a day. That's a big increase. I don't know if they can do it or not. There's a lot of leakage around OPEC and OPEC plus, people cheating. There's a lot. The Russians will produce as much oil as they can to finance their war, oil being sold into India and China at a discount, and American production's coming up. So I'm less bullish. I think, it's possible we get there, but if we were to get there, it would be very temporary. I think there's going to be more downward pressure.
All right, where would you put, just ballpark, a price for a barrel?
You mean by the end of the year where EIA is? I think it will be where we are now or lower. I mean, I would say probably back into the upper 70s, mid to upper 70s, maybe around 80.
Saudi Arabia apparently is still extending its production cut. I mean, that should have upwards pressure, right?
Yeah, they have less power than I think they used to. And I think, keep in mind, trading happens with the marginal barrels on the edge of the market. So there's upward and downward movement, a few dollars here and there on news. But the Saudi efforts are, they're offset, I think, to a large degree by some of the factors I mentioned. Production from North America, the Iranians, all kinds of production, perhaps coming online over the next few years out of South America. So I think that they are being very defensive, and I think that's a move that we can expect them to make, but I don't think they have as much power over the market as they used to.
What about the impact of demand? I think that should be going up a little bit.
Yeah, but I think that it depends on who you believe in terms of recession and what's happening worldwide. I think there's still a tremendous amount of growing demand throughout the developing world, Southeast Asia, Southwest Asia. I think that, that offsets flattening demand to some degree in Europe and North America. I do think demand, however, is still increasing. And, normally, again, that would be bullish for prices, but I just think there's a lot of supply and there's a lot of potential for supply. Keep in mind, it's a commodity. So when prices are high, you want to sell more of the commodity, and it causes production to go up, regardless of what the Saudis do.
So where do you think the EIA is coming from then?
I'm not sure. I use their data lots. It's a terrific institution. I think that they have models I don't have access to. I mean, we're not that far apart. I'm just less bullish. I think I believe that we'll be lower than where they are at the end of the year. We'll see, but I'm not sure. I've read their paper. I think it's based more on demand outstripping supply. I'm just more bullish on the ability of countries that produce and companies that produce to produce more barrels more rapidly.
So then, in your view, gas prices at the pump will be little changed this year?
We're in this trading range. Yeah, I mean, 5-10 cents either way. I don't see a spike higher, and I don't really see dramatic declines. That, I think, is more impacted on the demand side. I think that there's still a great deal of the working population in the U.S. particularly that's not commuting. People spoke of the summer driving season. I don't think it really happened. We're seeing news from that WeWork company, which is the office sharing company that used to have a $40 billion valuation. Now they're in deep trouble because they've said that people are staying home. So I think the gasoline picture is more in the U.S. is more on the demand side. I think there's a lot of demand for refined products, gasoline, diesel, jet fuel, especially throughout the Asian landmass and Southeast Asia.
Do you think over the next 5 to 10 years, do you think oil production will peak or will just continue going up?
5 to 10 years is a long horizon. I think over the next 5 years, sir, I do not think so. No, I don't see that happening. When you get to 10 and beyond, then it's a harder market to model because we don't know how rapidly electrification may or may not happen. I would say over 5 years, no, I don't see that happening. Once we get to 10, 15, 20, it becomes a much more complicated argument that it's just going to take more analysis.
So then if we're not going to see a peak, would it be safe to assume that gas prices would also follow suit, going up?
I mean, in the 5-year time horizon?
Right.
No, it just depends. The gasoline story just depends on which market you're in. You have places like Central and Western Europe and North America where there is much more of an ability to telecommute, to work from home. You know, it's a global market. I think the demand for fuels will continue to rise particularly because of Asia, growing demand perhaps in Africa, Latin America. I see tremendous demand continuing throughout all of Asia, and I'm including the subcontinent, right? India as well, the most populous country in the world. So globally, I don't see that happen. I think if there's flattening or lower demand for refined products in the developed world, I still think it's offset by the developing world.
What do you think about China? Because people are talking about how its pandemic recovery has been slowing. What's the dynamic here in terms of using oil?
I think it's still a very oil-thirsty economy. It's hard to know. It's hard to know what data we're getting out of the PRC that is current and how accurate it is. I think that, what we're seeing is a slowing economy that's from published data, but it's just hard to know. I think there's a tremendous amount of demand, certainly from the PLA, the large, military complex there. I mean, how do you fuel, military and still going to be demand for a variety of refined products. So I don't know. It's just hard to know what data we're getting that is exactly correct, reasonably correct, or not correct. I think, though, that Asia isn't just a story of China. It's a lot of Southeast Asia alone is 700 million people, and India, the largest country in the world. So I think it's a mixture of data. It's just hard to say because I do not know which data points are current and accurate.
All right, maybe just one more question. From what you're seeing in the energy sector, are there signs pointing to a recession coming?
I'm not seeing it in North America. I'm not seeing it here. There's a lot of business activity, a lot of manufacturing activity. The coast here, the Gulf Coast, is very busy. We have a lot of activity out of the ports along the Gulf Coast here, including Houston. So it depends where you are. The difference in this time around with recession or no recession is how fragmented it is. In the United States, you have specific states that are having difficulties. In other areas, like here, I'm in Texas, there's no indication of recession. I see a lot of traffic, people are busy, the unemployment rate is very low. So I just don't see that. Europe, however, looks to be much more problematic. The growth rates are very low. They're very close to zero compound annual GDP growth rate. So it depends where you are. I think that North America is growing, and I think Asia is growing, and other parts of the world, it remains to be seen.
All right. Thank you so much today, Tom.
Hey, great to see you.